Good evening and welcome to Kenya News Update today. I'm your host, David Mwangi. Tonight, we're diving deep into one of the most consequential and controversial economic strategies of the Ruto administration, the plan to fund a 1.2 trillion shilling mega infrastructure plan by selling off state assets. This is a story of grand ambition, fierce debate, and a fundamental question about the future of Kenya's economy. Is this a bold move to unlock value and build a modern nation, or a dangerous fire sale of the family silver? We'll examine the plan, the numbers, the politics, and the profound environmental contradiction at its heart. This is a 12-minute deep dive. Let's begin. Our story starts with a staggering number, 1.2 trillion shillings. That is the estimated price tag for what President William Ruto's government calls its transformative mega infrastructure plan. We're talking about roads, railways, ports, energy grids, and digital highways designed to propel Kenya into a new era of economic growth. But in a nation where tax revenues are stretched and public debt stands at over 11 trillion shillings, the question is simple: where does the money come from? The government's answer, unveiled in recent weeks, is equally bold: sell what we own. Specifically, privatize a significant portfolio of state-owned corporations and use the proceeds to build it. President Ruto himself has framed this not as a retreat, but as a strategic advance. He argues that many of these assets are underperforming, trapped in bureaucratic inertia, and that by unlocking their value on the open market, Kenya can redirect capital to where it's desperately needed. It's a classic case of asset recycling, but the scale is unprecedented. We are not talking about a few small enterprises. The list, though not fully public, is believed to include stakes in everything from the Kenya Ports Authority and the Kenya Pipeline Company to the Kenya Electricity Generating Company, KENGEN, and the Kenya Airports Authority. The potential value is enormous, but so are the risks and the outcry. Let's break down the financial logic. The government's target, according to Treasury documents, is to raise at least 300 billion shillings from asset sales over the next 3 years. That's 300 billion shillings as a direct injection into the infrastructure fund. The remaining 900 billion would be leveraged through public-private partnerships, with the state's initial capital acting as a catalyst. The model has a recent precedent. The Kenya Pipeline Company's infrastructure bond, which raised 106 billion shillings last year, was hailed as a success. Proponents point to this as evidence that the market has appetite for well-managed state assets. But critics counter that selling a revenue-generating monopoly like the pipeline is fundamentally different from selling a strategic asset like a port or an airport. They ask, are we selling the goose that lays the golden egg just to buy a fancier coop? The economic debate hinges on efficiency versus sovereignty. Pro-privatization economists argue that private ownership brings discipline, innovation, and capital investment that sclerotic state corporations lack. They point to the successful turnaround of Telkom Kenya, now partly privately owned, as a case study. The opposing view, held by many in the opposition and trade unions, is that this is a short-term fix that surrenders long-term national control over critical infrastructure. They fear job losses, higher user fees for citizens, and the creation of private monopolies even more powerful than the public ones. Now, let's visualize the scale of this ambition. The 1.2 trillion shilling plan is broken down across several key sectors. According to the draft National Infrastructure Investment Plan, the largest share, approximately 40%, is earmarked for transport projects. This includes completing the Naivasha-Kisumu standard gauge railway line, expanding the Jomo Kenyatta International Airport, and building a new highway corridor from Mombasa to Nairobi. Energy projects, including geothermal and solar expansion, claim about 30% of the budget. Water and sanitation infrastructure takes 20%, while the final 10% is dedicated to digital infrastructure, like the national fiber optic backbone. To put that 1.2 trillion figure in perspective, it is equivalent to roughly 15% of Kenya's entire gross domestic product. It is more than double the national education budget for this financial year. The government's argument is that such a leap cannot be funded through incremental tax increases or more borrowing. A radical solution, they say, is required. But here is where our story takes a sharp, and some would say hypocritical, turn. While President Ruto champions the sale of state assets to fund concrete and steel, his administration is simultaneously embroiled in a separate controversy that strikes at the very heart of his environmental credentials. Recall that President Ruto has positioned himself as a global climate champion. At COP28, he pledged to lead Africa in a green revolution. His government's ambitious plan to plant 15 billion trees by 2032 is a centerpiece of this agenda. He speaks passionately about forest conservation. Yet, at this very moment, there is a significant uproar over state plans that environmentalists say constitute an invasion of the iconic Karura forest in Nairobi. The government has proposed excising a portion of the forest, reportedly for a road expansion and associated development. The Karura forest is not just any green space. It is a 1,200-hectare urban lung, a symbol of successful conservation fought for by the late Wangari Maathai. The plan has sparked outrage from conservation groups, residents, and opposition politicians. They accuse the president of saying one thing on the world stage and doing another at home. This creates a powerful narrative conflict, a leader selling assets to build infrastructure, while allegedly compromising protected forests for more infrastructure. It paints a picture of priorities where development, at almost any cost, trumps all other considerations, including environmental pledges and the preservation of public natural assets. This contradiction feeds directly into the political firestorm surrounding the privatization plan. The opposition, led by figures like Raila Odinga's Orange Democratic Movement, has seized on both issues. Just yesterday, key ODM senators, including Edwin Sifuna and James Orengo, publicly rejected a report from bipartisan talks between Raila Odinga and President Ruto, specifically citing concerns over the government's economic direction and environmental stewardship. They labeled the asset sale agenda as economic surrender. This political resistance is crucial. For the privatization plan to succeed, it requires not just a presidential directive, but parliamentary approval. Each major sale would likely need to be ratified by the National Assembly. With the government holding a slim majority and facing intense public scrutiny, the battle will be fought vote by vote, asset by asset. The opposition's strategy is to frame this as a betrayal of the hustler narrative that brought Ruto to power. They ask, if the goal is to empower the common Wenanchi, why sell the assets that belong to them to wealthy investors, both local and foreign? The government's counter-narrative is about future empowerment, building the roads, power lines, and ports that will create millions of jobs and lower the cost of living for those very hustlers. Let's examine some potential candidates for the bloc. While the full list is confidential, analysis from financial institutions points to several high-value targets. First, a further stake in Safaricom. The government already sold a portion, but an additional sale of, say, 5% could raise upwards of 50 billion shillings. Second, the Kenya Ports Authority. A minority stake sale in the port of Mombasa, Africa's second busiest port, could fetch between 80 and 120 billion shillings. Third, the Kenya Electricity Generating Company, KENGEN, selling a 25% stake could generate around 30 billion shillings. Fourth, the Kenya Airports Authority. Partial privatization of JKIA and other airports is a perennial discussion, with estimates around 40 billion shillings. And fifth, a collection of commercial sugar millers and other agricultural parastatals, which could together raise 20 to 30 billion shillings. The total from just these five could approach 300 billion shillings, hitting the government's 3-year target. But each comes with a political landmine. The ports and airports are seen as sovereign gems. KENGEN is critical for energy security. The sugar mills are in politically volatile zones. The execution will be a monumental challenge. Beyond the politics, there are serious technical and social questions. Who will buy these assets? The government hopes for a mix of local institutional investors, like pension funds, and strategic international partners. But there is a real risk of a lack of transparency, of sweetheart deals to politically connected individuals, a phenomenon Kenyans know all too well. Then there is the workforce. State corporations employ hundreds of thousands of Kenyans. While the government promises that new owners will honor existing contracts, history shows that privatization often leads to restructuring and job cuts to improve efficiency. The Kenya Railways Corporation, after the Rift Valley Railways concession, is a cautionary tale. Furthermore, what happens to the pricing of essential services? If a private entity takes over a port or a power generator, will their primary motive be public service or shareholder profit? The government promises robust regulatory frameworks, but regulators in Kenya have often been criticized as being weak or captured. So, where does this leave us? We have a government with a massive vision, funded by a radical and risky method. We have a president championing climate action, while his government faces allegations of undermining a flagship forest. we have a political opposition digging in for a fierce fight over the soul of the nation's economy. And we have the Kenyan public, waiting to see if this grand bargain will deliver prosperity or become another chapter of elite wealth accumulation. The stakes could not be higher. The 1.2 trillion shillings is not just a number on a page. It represents a potential transformation of the Kenyan landscape, for better or for worse. The coming months will be decisive. As Parliament reconvenes and the first concrete sale proposals are tabled, every Kenyan should pay close attention. This is more than an economic policy. It's a choice about what kind of country Kenya wants to be. Does it trust the market to build its future, or does it believe the state must retain control of its crown jewels? The debate is now open, and it will define the Ruto presidency. For Kenya News Update today, I'm David Mwangi. Thank you for watching. Subscribe to Kenya News Update today.